I'm actually going to be sharing my screen. I'll be coming from the KM account, so let me do that right now.
And Ken, by the way, we love your group. It's growing really fast, and hopefully we can help you to grow it to 100,000 followers as soon as possible.
Thank you. I think we just want to make sure that the group, is able to successfully share information with each other, and hopefully everybody can learn and grow. But for my presentation today, thank you, Ed, for inviting me to present. I'll just be sharing, dividends at a very high level. If you are very experienced already in the market with dividends, this might be very much a review for you. But I would love to tailor this for people who are just, getting their feet wet and want to learn more about, this opportunity to diversify their portfolio. A little bit about myself, as Ed mentioned, my background is in venture capital and blockchain technologies. I've been trading in equities markets for the last over a decade. Had my trend of day trading in college, for better or for worse, but moved into venture capital side. And if anyone has any questions and regarding investing in startups, accredited investing, feel free to DM me on Facebook. But let's get this presentation started. So let's start with the basics. What are dividends? And what they are is they're a distribution of a payout of a company's revenue to eligible stakeholders. Actually what happens is the board of director approves dividends. So this means that dividends aren't actually guaranteed to be paid out, but usually that's under specific and rare circumstance. So at its root, a company announces when a dividend will be paid, the amount that will be paid, as well as the ex-dividend date, which we will talk about in a bit later. So commonly, a dividend is paid in a cash distribution to your shareholders' brokerage account. So if you have your money in Schwab or in other stakeholder brokerage, you'll get your cash distribution paid there. Alternatively, we see dividends also being paid in new shares of stock. This is also considered what we call DRIPs, or dividend reinvestment programs, where you can actually reinvest your dividend back into more additional stock. And sometimes you can do this at a discount. So it also offers an alternative strategy opposed to just being paid in cash. You can kind of compoundly grow your invested interest within a company through these types of programs. So more importantly, I think we're all curious is how do we make money? And well, first off, you need to be what we call a shareholder of record on or before the dividend qualification date. So this means that you need to own the stock before the specific date that's relegated towards the dividend. So stocks are considered ex-dividend if they're traded without dividend eligibility, meaning that they're being traded after the qualification date. On the flip side, if you do choose to sell your stock after the ex-dividend date, you will still receive that dividend. So, if you do predict that something may happen to the overall stock price, feel free to be trading and be comfortable that you'll still be paid your dividend. The amount of dividend is proportional to how much stock you own. This will be explained later with the yield and how much the return is. But if you own more of a stock, you'll be received more proportional dividend. And then another option is if you don't want to choose individual stocks, there are plenty of dividend-focused mutual funds or exchange funds that do offer that basket case portfolio to help out if you aren't too savvy about choosing individual companies or doing analysis. So let's kind of break down how dividends work. So let's say you buy 100 shares of PSI at $10 USD per share. So this leaves us at $1,000 invested principal that we have. PSI pays an annual dividend of 25 cents. And so after a year in the qualification date, you would receive $25 in dividend payments, which doesn't seem too much, but it does turn out to be about 2.5% yield, which is better than, savings accounts, other more what we consider stable investment vessels, and overall offers a very predictable return for your portfolio. So the important term that you'll hear a lot thrown around in dividends is what we call dividend yield. And the way that we calculate this is the annual dividend over stock price and times 100, because we calculate it as a percentage. So people, investors, analysts like to use this as the main comparison metric between different dividend stocks. Generally, the higher yield means you'll be receiving more money over that period. However, this yield can change over time. It can be dividend prices can be increased or decreased by a company, or can change based on reflected market fluctuations. So yield and stock price generally are inversely correlated. As the stock price goes up, generally yield goes down because you'll be receiving the capital gains from the stock on top of the amount of dividends you'll be receiving for holding your portfolio. So for actually the dividend yield to go up, a company has to A, either raise their dividend, or B, the price goes down, but the dividend is still constant. So those are the only two scenarios where we'll see the dividend yield increase over time. However, high yield isn't necessarily everything. It may seem like for dividends, you want to be choosing companies that offer that high yield dividend so you get that solid amount of percentage return. But that doesn't always mean it's a great investment, and in some cases may indicate trouble. It could indicate that the stock price has fallen below expectations and dividends may be cut. It also can show maybe the company is not sustainable and it's currently at risk, or there's weak demand. So, for these companies that, aren't high growth and they offer these dividends, generally they're more mature, well-established, and they issue dividends because they don't invest as much as revenue back in their company. And they want to attract you as an investor to invest in them, not based on the movement of their stock price, but in the return that you'll receive from dividends. So generally tech and bio, pharmaceuticals don't pay dividends because they reinvest a lot of their profits for high growth. But let's look at like GM. So in the mid 2000s, we all know what happened to GM in 2009. But before then, they had an offer of 10% plus yield over a couple year period, which seemed very attractive for a lot of investors at the time to put money into GM, return that 10% per year. But actually, the price dropped over that 3-year period from 60 to sub $20 USD. So in the long run, you're losing much more higher percentage of your investment than you were returning on the dividends. So that's kind of the things you need to consider when you look at these companies, that you need to make sure that it's also a sustainable pick and that its stock price will be consistent for you to actually make any gains on that yield and the return. So some other important metrics that I think is good to look at when you choose dividend stocks is your payout ratio. So the dividend as a percentage of the company's net income. Generally speaking, this means that the lower the ratio, the more sustainable the company. So that company is paying a small amount of their revenue out as dividends, so the rest of the money can be used for the sustainability of the company long term. Second is total return. It's always important to check the overall performance of the asset. So that is the gains of the dividend plus the gain loss percentage of that company. So you would be like 3% from the dividend plus maybe plus 6% from the stock price over the year. So you'll have a 9% total return. That total return can also be negative, as we saw in the case of GM, if the loss outweighs the percentage of the dividend. Next is EPS. So we have the earnings per share. Growing EPS does indicate strength to consistently pay dividends and potentially increase it over time. So this is a generally good metric to look at. And if it's been growing over time, maybe something that you want to look at as an investable asset. And then PE ratio, the classic price to earnings ratio, look to see if it's fairly valued, generally to be used at any equity or stock that you want to look at as an investable, as an investment in your portfolio. So, as we mentioned earlier, dividends isn't all great and it's not guaranteed money. There are some downsides to it. And as I said earlier, that dividends aren't guaranteed. Companies can choose not to pay dividends. And we saw this in 08-09 in the financial crisis, where major banks eliminated or slashed their dividend payouts despite consistent payouts and stable histories beforehand. Also, I think recently we saw that the Fed did announce that this may happen again to major banks and certain companies. So definitely choosing stocks right now. Keep a lookout for, is there a danger of this dividend getting slashed or potentially eliminated? Going back to kind of the idea of dividends in general, these companies aren't usually high growth companies. They're mature, well-established auto manufacturers, blue chips that need to get more investment in them, incentivize the shareholders by using dividends as that vessel, opposed to a company that's like high growth and you bet on them because their stock price is going to raise 20%, 30% over a 5-year basis. Average, I think over the last like decade or so, the average dividend on the S&P 500 index was about 2 to 5% roughly. I think we consider 4% like that golden like ratio of like a target interest. But if you're looking to invest in anything that's over like 8%, 9%, or God forbid, moving to the double figures, please do your homework. Like that's when it gets a little bit dangerous. That these are pretty much unstable companies. There's a reason why they're offering such a high yield for their dividends, and you need to look at the capital gain and loss over their stock price, or maybe something fishy going on behind the scenes. And always remember, the stock price is related to the yield. So most importantly is what I'm always concerned about is how do I get taxed? Most dividend payouts is what we consider is qualified dividends. So they're taxed normally at about 0 to 20% rate. This is from what I gather from U.S. investment, since I'm based in the United States, which is lower than ordinary income taxes. However, some higher tax rates due to corporate structures such as REITs or MLPs do offer actual higher taxes than the standard dividend. And if you have a tax advantage retirement account, we can generally ignore the tax. However, some exceptions do apply. I think MLPs do get taxed in like a Roth IRA, but that's up to the specific vessel that you are using. So I would check the rules there. So I'd like to conclude this kind of like quick presentation on some general strategy about investing in dividends and if you should diversify your portfolio. We have basically 3 different strategies here. The first is what we consider high dividend yield. So people that are looking to invest in stocks that have that high dividend yield. So you focus on these slow growing companies with good cash flow, good healthy metrics and financials. And then this will return you in theory larger dividend payments and more immediate returns. And when I speak about immediate returns, I'm not talking about like, hourly day trading type of stuff. Quarterly, annual, in the longer sense of a little bit more secure return in that sense. Second is what we call high dividend growth. This is kind of the opposite focus, is where you're focusing on these fast growing companies that have lower yields. My personal one that I like to look at right now was Home Depot and Lowe's. I think they both offer around like a 2% yield. But they have been growing pretty fast in the last 3 months. So what this does is that you're not looking for that immediate return on the dividend, but instead large potential capital gains over the long term. So 5 to 10 years out, you're looking at not just the gains from the dividend, but also the growth of the stock price over time. And the last is one of my favorites. It's just the drip method, which is more of like a fire and forget. So if you remember from earlier, we talked about those specific dividend programs, where you can invest your dividends back into additional shares. That's what this strategy would be. So you can play that compound interest game and compoundly grow your ownership and your invested interest in a company. And then if you really invested and believe in it, you will reap the benefits largely over the long period of time. As always, do what's best suited for your portfolio, investment thesis, and goals. Generally, dividend strategy is not a short-term strategy. Most people don't play it quarterly. We're looking at years where this is kind of offset. It kind of provides an alternative to low interest savings accounts, etc. A little bit more stable, 2 to 3% gain per year. And overall, the TLDR of this whole presentation, it's dividends is a strategy for predictable long-term returns. And if you're looking to diversify your portfolio in that sense, I think that dividends is a good option to look at in that for that strategy. As always, this is not any investment interest or etc. Just for the disclaimer. But if you have any questions about specific like dividends, or just general things and etc. about the markets, feel free to ask me. And that's it. Thank you, Ed.